When it comes to finding value right now, our next guest sees bonds becoming more attractive than stocks, bullish on gold and oil, and she joins us with her least preferred view on global and U.S. equities. Joining us today, UBS Alli McCartney's Managing Director, Alli McCartney. Alli, it's great to have you. Happy Friday. I know you've been on alert for most of the year on potential risks. We mentioned at the top of the show that you see some of them receding. Is that right? And which ones?
Well, look, I mean, most of the conversations that we've had and that have been, dominating the financial media for this first half have been about the precariousness and the murkiness of the data. You just talked about everything from University of Michigan, CPI, PPI, bank earnings, health of the consumer. It's not murky right now. It's actually overwhelmingly positive. And so in a way, we have a market that seems to have, whether for emotional reasons or for quantitative reasons, anticipated that and is quite priced to perfection. So I guess the good news here is that the data is starting to show the positives that exist in this economy. And the economy and the U.S. consumer and U.S. households seem to be like a little engine that could at this point. But to your point, I don't think we are out of the woods yet, right? Because the expectation going forward is that we continue to see progress on inflation, although likely, as every guest you've had on this morning has pointed to, it is less quick and less what have you done for me lately than we've seen a little bit. We're going to continue to see slowing growth. And I think the real question right now is around the uncertainty and the timing and effect of 5% and what looks like will be somewhere between 5.25% and 5.5% of rates. And so that puts bonds with the kind of rates that you can get when you're talking about, going out 1 to 3 to 5 years in the, we can tell you and we can show you the expectation. Whereas with equities, there are a number of things that have to fall in place to make the next 6 months look like the past 6 months.
Which is what, primarily, for you to be recommending to your clients to either add more exposure or stay in?
So for equity markets, full stop, let's say for the S&P, certainly on an equal weighted basis, to continue to outperform, the Fed, inflation has to go the path that we think. It has to go down. It has to go down quickly. And so the Fed has 1, maybe 2 more rate hikes and then goes the other way. Second, this widely predicted U.S. recession has to be full on canceled, right? We stick the soft landing. We move on. The labor market capitulates. Fed says, OK, we're reversing course. And third, all of, the last 6 months has been the best half we've, with the second best half we've seen in 20 years, largely driven by optimism over AI. And that seems a little precarious. I think what really, really has to happen, Sarah, is that what we've seen since June 1st, with cyclicals slightly outperforming tech and AI, is that we have to start to see that. And we have to go from an economy and a market that has rewarded and charged multiple expansion to really showing earnings growth. And I think we'll start to see that in 2024, but there's no reason to believe that we're going to see that in 2023.
How would you gauge sentiment right now among your usually higher net worth clients? Because I said the pain trade is higher. It does still feel that way. It feels like everybody's still a little bit negative.
I think everybody's a little bit negative, but then there's also this FOMO, whether it's around AI, whether it's around inflation, whether, it's around cryptocurrencies. Oh, there goes my doggy in the back. And I think that, people are a little bit confused, right? And so when you have the following 3 things happen at the same time, I can get five, I think our savings rates right now are over 5%, right? I can give 5% in short-term cash. Markets have really rewarded me for staying in them. And bonds, you're telling me I can lock in somewhere between 4 and 6%, potentially with capital appreciation should rates go the other way. It's hard to get people to take any risk out of cash. But at some point, that's going to happen, right? And you saw that in the banking numbers today with deposit rates coming down. So my sense is that this summer is going to be a time where both institutions and individuals are really taking stock of what they have, where they're invested, have they reallocated based on the first 6 months of the year. And then come September, because again, also the July meeting is sort of a foregone conclusion. The September meeting is anybody's guess and data dependent, that I think we're going to see a pretty quiet summer where the VIX stays pretty low. And then when we have sort of back to school, back to work, and we start to have more of an understanding of, is inflation capitulating? How are people feeling about the path forward? Then I think you'll start to see some more people leaning in and doing so with conviction as opposed to out of FOMO.
Ali, I wonder, when we start to get real non-financial earnings in a few days, how you're going to process the next couple of things. One is the spread between CPI and PPI and the lower input costs, the effect on margins, and then the dollar. I mean, and the tailwind that maybe not show up in this particular set of prints, but definitely in Q3. I mean, how much of a tailwind is that going to be, at least for multinationals?
Well, look, we've been saying for quarters at this point that it will start to be a tailwind instead of a headwind, and we've been wrong. So I think everything, in a sense, whether you look at UBS or you look at anyone on the street, the last 6 months from a whole host of things, right? We all had a view that OPEC was constraining supply and that would affect oil. Everything has sort of been a anti-consensus to this point. So I think what starts to happen is we start to see a little more, quote unquote, consensus, sort of what you would expect as an economist to start playing out in the numbers. I think that the dollar will start to help U.S. companies, absolutely. Now, the question is, again, does that help earnings in a sustainable way, or is it really sort of a, quarter by quarter, the dollar is going to either be your headwind or tailwind, but you're not actually increasing the sustainability and the margin going forward? And I think that's what we have to start seeing. We have to start seeing the CPI and the PPI look, that companies can make decisions because they understand where the cost of labor is going, what their consumer can afford, and what their input costs. And month to month has really just been, in a sense, a coin flip. And there's not been a lot of predictability for C-suite teams right now. And I've seen that as frustrating for investors as well as for my C-suite teams.
Yeah, that might be why sometimes the street kind of sets the Forex stuff aside. We'll see how much it does impact the next set of numbers. Ali, have a great weekend.
Exactly.
Talk to you soon.
Thank you. You too. Nice to see you both.